Morning, Olivia.
Hi James, how are you?
All right, thank you. We can hear you loud and clear. That's
Oh,
also
good.
cool.
That's
Um,
my biggest concern. We sometimes have some issues here, but I'm on the main frame, so hopefully there won't be any problems.
cool. Good. Okay. Good stuff. All right. If you don't mind putting yourself on mute until we're ready, that'd be cool.
Yep,
My bit
perfect.
should be fairly quickly. Then obviously we've got Andrew Majedie. So as I say, probably be about 25 past, but we'll get to you. And if we're sort of running out of time, we'll run on a little bit, but we don't want
Okay.
12.
I was practicing what I was going to say last night. Sorry, I don't do these super often, so I'm probably at a little more scripted end. I will try and make it sound not too scripted. But I think I was running to about 15 minutes. Is that
Perfect.
okay for the intro?
Totally perfect.
Oh,
Yeah.
brilliant.
Yeah.
And I think in terms of you controlling the slide deck,
Mhm.
do you want me to say when to move through, or are you happy to kind of,
I can try and second guess it, but if I'm not doing it right, shout at me.
okay, perfect. That sounds
Cool.
great.
All right then. Fantastic. Talk to you
Excellent.
later.
I
Cheers.
will
Bye
mute
bye.
myself and
Thank
hopefully
you.
unmute myself at the right moment.
Cool. Okay. Ta.
Morning, James.
Morning, Andrew. All good?
Yes, thank you. All well with you?
Yeah, not too bad, thank you.
Marvelous. Good. All set as normal.
Cool. Good. All right. Good stuff. I'll talk to you in a bit.
Yeah.
It was 11 o'clock. We'll get going, I think, because there's a bit to get through this morning. So I'm going to be doing bits of news. Then we're obviously going to be talking to Andrew Majedie about what happened during the course of May. And then our guest this week is Olivia Macdonald from Majedie Investments. It should be interesting to see what has been going on there since they took it over. So bits of news this morning. I want to mainly focus on Gresham House Energy Storage, really, and little bits on the Octopus and the Hypnosis stories too. Gresham first then. So this was doing very well, and then the discount cracked and the NAV has slid a bit, and it's still on a discount of about 52%. And all of this was really triggered. If you remember, we talked about this on the show on the 2nd of February, but there were problems with its revenue in the UK, and that was related to the way that the National Grid was treating it and the balancing mechanism, and also to a relatively low volatility of energy prices. So when they announced a trading update at the end of April, they said basically this is the most challenging operating environment we've had since we started. And given where they were, they said we need to prioritize paying down debt, keeping cash to build what they wanted to carry on building out. And so for that reason, we're not going to pay dividends this year, and we're also not going to buy back any stock. That is one of the big triggers for the big discount. And the NAV has gone down on the back of all of this. So they wrote it down as at the end of December 23 to 129.1p. It's possible it will come down a little bit more than this, but we'll see. I'm not guaranteed on that. When they published the results on 29th of April, they said that because they're keeping this money back to build out what they've committed to building, and there's already kind of in progress, they'll end up with more than 1,000 megawatts of batteries. And because some of those are more than 1 hour duration, that's like about 1,700 megawatt hours worth of capacity. And that makes them the largest player in the GB market with about 20% market share. There are others coming along behind them that are building stuff, but at the moment they are the market leader. And obviously that is quite a special position to be in. One of the things that they decided they wanted to do was look at how the debt was financed. So most of these things were sort of set up with revolving credit facilities so that they could build stuff out and then sell it on, or commit to building things and then raise more equity. Obviously, they can't raise more equity in the current environment. So to get all this done, as I've said, they need to borrow some more money. They've reduced the size of their debt facility because that was up to well over 300 million, and so that they've cut that down now, and they think the debt will peak at about 175 million pounds, and they're trying to reduce that a bit and also prove how accurate the NAV is by selling bits of the portfolio. So they're looking at some of the smaller projects and see if they can sell those, but nothing's happened on that front yet, and we'll have to wait and see whether that does happen. They are optimistic that the revenues will sort themselves out. As we'll discuss in a second, like the more renewables there are on the grid, the more volatile prices are, and that the proportion of renewables on the grid is rising and still rising quite quickly, actually. And also the problems that they've had with the balancing mechanism are being sorted out very slowly. And there's been progress already this year, as we flagged that there would be. And things seem to be moving in the right direction. So there are reasons for optimism. So this chart here is from the government department and sponsor to charge these things, and it's just showing you the generation mix. And you can see the coal just dwindling to almost nothing. There was still some coal in the system at the end of the year. That's now all gone, and those plants have been closed, and there's no more of those. Obviously, gas has become more important in all of this, and that's why the power prices shot up and gas prices shot up on the back of Ukraine. Nuclear they keep talking about making that a much bigger slice of the pie, but there's very slow progress on that, and I'm not completely convinced it's going to happen. And obviously, wind and solar has been the thing that's taking up the slack here. So there's been more and more of that. And then you can also see that the amount of energy being generated overall has actually slid a bit. And that is a reflection of how much tighter the market's become within the UK. So you do get bigger swings. And because of the way that the whole thing's set up now with renewables, it makes prices more volatile. Now, these charts come from the balancing mechanism through National Grid ESA, which is being privatized, and so not privatized, being nationalized, and it will be so the National Grid would be no longer involved in it directly. What these charts are showing, that the orange bits, which is this axis on this side, is the imbalance between what's being generated and what's being demanded. And so obviously the solar's not working at night. I've marked sunrise and sunset on these. And the wind is variable. Nuclear and things are kind of baseload, so they just generate all the time. And gas, they can switch on, switch off. But because you've got this imbalance here, you get big swings in the prices. So it got very windy on the 6th of June as Storm Karen was approaching, and that meant there was too much power on the grid for big chunks of the day. And that's when you get these big negative prices. And what they do then is they actually pay the wind farms not to generate, which is a huge waste of electricity. And it'd be much better if it was stored and then released by the batteries. And this is something that the battery people have been working for a long time. And then a more normal sunny day, so we've got this sort of from the 3rd of June here, you get to much lower variations in the supply and demand balance and much less chance of negative prices. And sometimes you'll just have positive prices going all the way through the day. And that's definitely true if it's not very windy and not very sunny. So because you've got these big swings on the intraday price, you can trade that if you're a battery operator. So you can try and actually buy at negative prices sometimes and actually sell at positive ones. And that is a way of making money. But it's something to bear in mind when we come and talk about what's going on now. So what they've done this week is they've entered an arrangement with Octopus Energy for, well, they say about half the capacity. It's obviously in terms of megawatt hours, it's more than that. And they're basically handing over control of those batteries to Octopus Energy in exchange for a fixed fee. So those arrangements last for 2 years. They start from 1st of July, but they're staggered starts, so not everything will be transferred over in one go. They still get revenues from the National Grid for managing the capacity market, and they are about kind of £10 million a year on these things. And they've said that combined with what they're getting from Octopus, they're getting about 43 million a year at the peak. So you can imply that it's about sort of 33 million of money coming from Octopus. And they, because they know that this money's going to come in on a big chunk of the portfolio, they think that they can almost guarantee that they'll be able to restart paying dividends in 2025. Now, Octopus Energy has sort of come from nowhere to be the biggest supplier of energy in the UK. This is just showing you all of the different people, all the different market shares. So they supply energy to about 6.8 million homes now, helped by doing things like buying Shell Energy's business. So they're a quite serious player, but they've come up from nowhere. So they can use this battery capacity because they've committed to supply renewable energy to their customers. They're exposed to these big swings in prices intraday. And so they're using the battery stuff, they've got a way to offset that. They can also just use them to make money the same way that Grid would have done. So Octopus, it's a much better, gives it much more kind of security over its input costs, in more better know where these things are going to be. Grid gets a much more predictable revenue stream. Where it might miss out is that if the optimism proves true and the revenues on batteries go shooting up again, they'll obviously miss out on part of that, but only for 2 years. So with all of that, Grid is saying that he doesn't think the NAV is going to be much affected by this. So I do think, sorry, I do think that this is kind of a good deal for both parties at the moment. But it's going to be interesting to see how it plays out, because obviously Octopus is not the only player in the market, and there are others that might be interested in doing these sorts of deals, and there are other battery storage companies out there that might want to join in. We'll have to wait and see. Now, Octopus Renewables, just briefly, I mean, this is obviously Octopus is part of the same thing, but we're not talking about that was Octopus Energy, and this is a completely separate thing. It's a fund generating power from around Europe. And as with all of these things, its share price cracked. It's gone to a big discount, about 28%. And its NAV's been drifting off too. But it's still a decent size, about 400 million. So if you remember, this tried to argue that it should merge with Aquila European. And we said at the time we didn't see the point of that. But I think what might have been going on there is that they might have thought, well, this might be a way to address our balance sheet, because its gearing is way too high. So at the end of March, the loan to value ratio on it was 47%, which is equivalent to gearing. So loan to value obviously is like the gross assets. The net assets, that's 89% almost, which is the highest in the sector. And a big chunk of this is floating rate, and they're paying 2% over the base rate, SONIA. And so that's quite expensive for them. So to try and address this, they launched a capital recycling program last year. So they've been trying to sell things off, and they've had some success with that. They've sold a couple of wind farms. They've decided they're not going to build out their Spanish solar stuff. The disposals actually added to the NAV. So that's all good. But what they've said this week is that they want to do a £10 million share buyback. I just think that's slightly put the cart before the horse. I think they should have waited until they've done more disposals and the balance sheet was in better shape. Because obviously the only way they can fund those share buybacks at the moment is through taking on more debt. And that doesn't seem to be like a desperately good idea. So they are trying to renegotiate the debt facilities. They're looking at, can they put more fixed rate debt in and pay back their revolving debt facility. We'll have to wait and see. But I just do think this is a bit precarious, and I think that the buyback is a bit premature. Lastly, Hypnosis. Because I don't recall ever seeing this ever, not just in our sector, but just generally. Blackstone have won this auction for Hypnosis. It was a done deal, and they've put the bid price up, which I think was very generous of them. Thanks very much. But I just don't remember ever seeing it before. So I thought I'd flag it. They say it's because the expenses of doing the deal are lower than they thought they were going to be. But I don't think they have to do this, so this is all quite good news. There is no competition inquiry, so that will remove one problem for getting this thing done quickly. They are going to publish some documents very soon. They say by the end this time next week. Then we'll have a proper timetable then. They're still saying completion within this third quarter that we're it sort of starts on 30th of June. So yeah, all good news really, but it's just strange that they've done this. Right, enough from me. Let's just hand over to Andrew.
Great, thank you very much, James. That was all very interesting, and I will just switch over my screen here and then talk about the movers over the month. Just before I do, just a quick extra on Hypnosis songs, which is to do with the exchange rate, because of course it's the dollar offer, and the sterling dollar rate's been unusually strong, so it's gone up to 128, which means that the value of the offer has come down from 105 pence to about 102.4, I think, which is just relevant if you were thinking of selling out in the market instead. So as you say, the generosity of Blackstone there is somewhat balanced. Anyway, last month was a pretty decent one for investment trusts, and the average trust went up by about 2%, really in line with global equity markets, which were having a reasonable month. And the UK market, of course, went up. We saw the FTSE 100 index breaks significantly through 8,000 and stay there. And actually, UK smaller companies also made some progress, which is a little more rare. So on the list of risers, there's plenty of double-digit gains there, including some UK smaller company trusts. So that's good to see. But I think there's a lot of special situations here as well. And obviously, there is a lot going on in the industry with all of this corporate activity. And I'll just talk about three of the risers that struck me as particularly interesting. So I'll talk about Crystal Amber, GCP, asset-backed income, and Hydrogen One capital growth. But there's some good rises there, and actually far fewer fallers of significance. Only two double-digit fallers here. Mainly the declines were quite muted. If I'm looking for a theme here, I think there's a few here which are emerging markets related. So you can see there's BlackRock, Latin American, India, Capital Growth Fund, Pacific Horizon Trust, JP Morgan China. But I'm not sure there was really that much of a theme. So I'm just going to pick one to talk about this morning, which is RIT Capital Partners, which has a relatively high profile and might be owned by quite a lot of investors watching this. So let's move on and talk about Crystal Amber, which I have spoken about before actually on these videos, because it's a very interesting special situations trust that has really some quite peculiar factors involved with it. But it's worth following. I think it's an interesting trust. And you can see it's actually had a good month. This is a year-to-date graph, and you can see this significant rise over the last couple of weeks, not apparently related to a rise in NAV here, but you can see the discounts come right into just under 20%, having been much wider. And there are some very specific reasons for that. But I think it's worth starting with a more general point, which is that this trust has been in wind down for 2 years. And when you read about trusts entering wind down, I think it's universally regarded as a bad thing when they say, look, it's going to take some time because we want to manage the wind down to make sure we're maximizing the value of the assets. And I think that's generally regarded negatively by the market because people want certainty and they want to know when they're going to get their money back and exactly how much it's going to be. But I think Crystal Amber is quite a good illustration, actually, of how that process can work very well, and that actually much more value can be generated from assets if they're sold at the right time. Because the trust actually did have quite a big win with its sale of Hurricane Energy at the end of last year, which really was at a much better price than anticipated. And it's had further good news now about two of its other holdings. One interesting one is the banknote printer De La Rue, which is a quoted company in London. And for ages now, the trust Crystal Amber has been saying in all of its reports that the strategic value of De La Rue is greater than its operational value, and that the company makes a very attractive takeover target. And sure enough, now De La Rue has announced it's in discussions which may lead to the sale of some of its divisions, or maybe all of its divisions. We'll have to wait and see. But that's been good news for the De La Rue share price, good news for the NAV of Crystal Amber Fund. At the same time, more or less, it's had good news from its largest holding, which is an unquoted holding in a medical devices company, Morphic Medical, which is basically accelerating its route to the market in the US. And so that augurs well again for the valuation there. This is quite an opaque trust, I find. It's quite difficult to get information from it or on it. It doesn't publish a nice monthly fact sheet to tell you what's going on. In fact, it doesn't announce its NAV either on a very regular basis. It's only once a month. So we don't yet know exactly how these gains, particularly in Morphic Medical, might translate into the monthly NAV. But the market is effectively taking into account the fact that the NAV is likely to be going up quite sharply, and that's why these have rallied. And it's hard to say whether there's good value here or not. Probably is still some decent value here. There's one extra factor that I think the market might be largely overlooking as well, which is that there's potential deferred consideration to come from the Hurricane Energy deal, which could be very significant. So there's quite a lot going on in the background here. I think we'll probably see Crystal Amber on the list of movers in future months to come as well. Next up, rather different, but actually similar charts, GCP asset-backed income, pretty flat for nearly all of this year, very flat actually, and then it's had this fairly sharp increase over the last couple of weeks. Again, you see this movement in the discount here coming in apparently quite sharply. Again, there's a very specific reason for this, which is that the company which has entered a managed wind down is starting to pay back capital. And the thing I found interesting about this is that this was all public information. Of course, we all know that the company is in managed wind down and more or less that it's going to have some of its assets available in the near term to give back to shareholders. But when Gabby announced that it was going to give money back, the market reacted as if it was a great surprise, actually, and marked the shares up, which I find a bit puzzling. But maybe there's a read across there, actually, that potentially if you're following other trusts that are in wind down that haven't said anything to the market in a little while, but you're anticipating a repayment of capital in the near term, that could actually harbor some additional value there. In this case, actually, there was a double dose of good news because initially Gabby said it was going to pay back £85 million. And then actually it had a further big loan repayment, which meant it could increase the repayment of capital to 143 million, which means it's going to instigate a mandatory repurchase of 37.5% of the share capital at NAV, which after the payment of the dividend is going to be 89.67 pence per share. So this was good news. There's just something I want to point out here, which is that if the market is working efficiently, and I think that maybe is an if, we should see the share price fall back again next week because the shares will go X this right, the buyback, the repurchase right. And that's really like passing an ex-dividend date because you're not going to have 37.5% of your shares bought at nearly 90 pence. So this should, in theory, mean that the share price should fall back next week after 10th of June from 78.6 to 72, I've worked out. That's just maths, so it'll be interesting to see if it does work out exactly like that. So in this case of companies returning capital, it's interesting that we see the spike up, but we should definitely see the spike down again. Let's see if that plays out that way. A different kind of rise now, Hydrogen One Capital Growth, which is a tremendously volatile stock on the whole. I'm not sure it shows up very well on this chart, actually, just because of the scale, but you can see it's effectively moved between 40 and 65 pence this year, which is actually quite a broad range. And if we were to take the chart further back, we'd see even more volatility. We've seen a rise again in the early part of May, which was due to the NAV release for the quarter. But if we, just before we move on, if we have a quick look at the chart here showing the discount, you can see these are big figures here. It's on a very big discount in common with many of its growth capital peers, because there's still not very much in the way of appetite for growth capital. There's still a lot of skepticism. And I think probably that's going to remain until we see a real shift in interest rates and people start to have a further look at more speculative growth investments. Nevertheless, the first quarter figure was good here. It was marginally up, which I think is good news in this environment. And it was good news for Hydrogen One because there was a currency headwind. But I think this trust is really approaching a very interesting point in its development now, because for a few months now, the managers have been talking about the maturity of the portfolio and how it's approaching the exit stage for some of its investments. And they say that 2 of its holdings have appointed bankers to consider exactly what they're going to do next. And I think this is the real acid test for the trust, particularly in the face of some current skepticism about the values. Because, of course, if you are achieving exits, actually real cash exits at a premium to your holding values, then that, I think, shifts how people will perceive the current NAV. So on this 50% discount, I think there's actually quite a lot of scope for positive response on any further news. Clearly, these are a bit of a high-risk proposition. They are extremely volatile, so not for everybody. But I think if you are of a speculative bent and willing to accept a lot of risk, then there's quite good scope for potential uplifts here. Changing tack now to something completely different. On the downside, RIT Capital Partners shares dropped about 10% this month. And this is such an interesting story, actually, and I think it's really a story of a fallen star. I've been looking at the market for a very long time, and RIT Capital was always, I think, held up as an exemplar of the benefits of the flexible investment sector, and the trust for many years was able to produce excellent statistics showing how it had benefited considerably on the upside during bullish market conditions, but actually protected value quite well on the downside, not participating in the downside anything near as much as the upside. And it did have a good track record for many years, but that seems to have faltered. And this chart, I'll explain exactly what I'm showing here. It's a longer term chart. It's 8 years. RIT Capital share price is the black line, and it's plotted here against the FTSE All World Index in blue, which is just a proxy. That's not really exactly what RIT is trying to track, but it's a decent comparison, I think, for anyone who's considering where they're putting their money in broad equity markets. And you can see that for many years, actually, there was a very strong correlation. And then it broke down, really, in the autumn of 2022, when we've seen, actually, global equities do quite well and RIT do very badly in share price terms. And a lot of that is down to this very significant derating that we've seen. And this is a year-to-date chart where you can see, actually, this year, the rating has generally been between 20 and 30% discount, which was unthinkable, actually, a few years ago with RIT Capital. And you can see this decline over the recent months, which followed, actually, a much better prior period. So I think what's happened here is that effectively this trust has lost its performance edge and it's lost its luster as a result. And it's been quite savagely marked down by a market which is not prepared to tolerate underperformance any longer. So, this discount, I think, is really quite remarkable because RIT did sustain a premium rating for a long time. And actually, as recently as the autumn of 2022, not really that long ago, it was still on a premium rating. So it's fallen off quite rapidly. And I think what happens many times with investment trusts is that they seem to anchor on a particular discount or premium rating. And my sense here is that RIT Capital has shifted to this new range. From what I've read and what I've observed in the market, the new range of acceptable valuations here seems to be a discount of between 20 and 30%. So of late, if you've basically bought on a 30 discount and sold when it rallies to 20 and vice versa, you've done quite well. So down to 28 now, which is at the broader end of that. We'll have to see what happens with the discount, but it may help actually if RIT is able to generate some good news from its private portfolio, which is really the source of much of the pessimism here. It's quite large at the moment, just over a third of assets, and the trust says it is going to reduce that down to something like a quarter over time, but it's going to need some exits, of course, to do that. The trust historically has had very low exposure to technology in its equity element, which is about 40% of the portfolio. And that's obviously caused it to lag quite considerably. I think it might want to address that because there's a new team in place, really. It's a self-managed trust. It has a new chief executive who joined in March. and the chief investment officer has only been in place since the end of last year. So I think investors may want to give them an opportunity to prove their worth now. But RIT has some work to do, I think. It is buying back shares to try and address that discount, but so far that doesn't seem to have been tremendously effective. I think it's going to be a really interesting trust to watch because it could go one of two ways, of course, but effectively, I think if the performance doesn't improve on a relative basis, we're probably going to see that existing discount range stick, so 20 to 30%. But I think there is a significant possibility actually that the performance will pick up, or there could be some shift in strategy here, which enables investors to look forward with more confidence. And at that point, we could see a re-rating. It's certainly one to watch, I think. On that rather non-committal note, James, I'll finish and hand back to you.
Oh, thank you, Andrew. There was a question actually in here just asking where do you think the board wants the discount to be? I think I'm pretty convinced the board wants it to be the discount's been a lot lower than where it is now. Do you agree?
Well, definitely. I mean, I think it probably is a source of some embarrassment at this time because of the wonderful history of the trust, actually, which is totally at odds with where it's currently sitting. So I'm not sure they'd like to have a discount at all. I mean, I think they'd like to get it back to a premium rating, but given that might be a little too ambitious at the moment, they've really got to be aiming to get that discount, I'd say, into, well, I mean, probably more in the 10 to 20% range to begin with, but certainly I think considerably narrower than this current position.
Yeah, I think that, I mean, they're quite optimistic though. They're going to sell things, and they're going to sell things for more than the NAV, and it's all going to be wonderful. So watch this space.
Yeah.
Thank you, Andrew. Now let's talk to Olivia. So good morning, Olivia.
Morning, James.
Thank you very much for doing this. Apologies that we're slightly later than expected. We might run on slightly longer, but we'll make sure you get your time to tell us all about the fund and what you're trying to do with it, please. So actually, I'm going to hand over to you for a while, just to let you sort of talk to us about the story, please.
Lovely. Well, thank you for having me. And I'm really delighted to be here to talk about Majedie Investments PLC. It's been a time of change for the trust. So let me start with a bit of context before sharing some colour on our investment approach and then turning to some key features of the trust. If you could flip forward one slide for me, please, James. So Majedie's origins lie in the early 20th century, specifically 1910. Sorry, back one. Thank you. And really, since 1910, the goal has been consistent: to grow and preserve generational wealth in a responsible manner, initially specifically for the Barlow family. In 1985, Majedie became an investment trust. And if we fast forward to the present day, following the sale of Majedie Asset Management to Lion Trust, the board wanted a fresh approach. So they went out to tender. Let's move forward a slide and see what they were looking for. Their focus remained on real wealth creation, in other words, inflation-beating returns, and they wanted equities to remain at the heart of the approach. But they were seeking something differentiated and idiosyncratic, something a bit different to what you could access through UCITS formats. They wanted experience, both with managing inflation plus mandates and with the investment trust format, and they wanted strong alignment with the manager regarding both financial success and culture. So following their review, we were pleased to be selected as the new manager and assumed responsibility for the trust following the January 2023 AGM. If we go forward one slide, and I'll introduce you to Marylebone Partners. We were founded over 10 years ago by our Chief Investment Officer, Dan Higgins, and have a long history managing money with a view to delivering inflation-beating returns for endowments, families, and high net worth individuals. Dan and I lead an experienced investment team, supported by an excellent investment committee and equally experienced colleagues on the operational and client side. To give you a sense of our backgrounds, Dan was previously the Chief Investment Officer at Fauchier Partners, a leading London-based fund of funds where, amongst his responsibilities, he ran their investment trust. And I joined Marylebone 7 years ago from the Wellcome Trust, the largest endowment in the UK. So let's move forward a slide and talk about our liquid endowment approach. Flip forward one more, thank you. This is built on the successful philosophy of the big US endowments to be long-term, fundamental, and focused on differentiated sources of returns. But we focus solely on the liquid markets. So we have no private equity, no venture capital, no property, and no infrastructure. We see plenty of opportunity in the liquid markets where pricing is more transparent and there's greater clarity around exit. And we manage with a real, i.e. above inflation return objective, 4% above UK CPI over rolling 5-year periods. And that includes a 3% a year dividend on NAV. This is what we've always done for over 10 years at Marylebone and also at our prior firms. But we also feel it suits the current investment environment well, where rates are structurally higher, macro and geopolitics are volatile, and there may be significant divergence in the fortunes of winners and losers. So let's move forward a slide and talk about how we do it. We've got 3 building blocks: direct investments, which are around a quarter of the portfolio today, external managers at just over half of the portfolio, and special investments, which are on their way to 15% of the portfolio and should rise further over time towards our near-term target of around 20%. We combine these 3 elements into a portfolio of differentiated ideas. We want to capture their return potential, so we manage a high conviction, relatively concentrated portfolio. But because the different elements are quite different to each other, their combination provides good diversification, reducing the long-term risk of permanent capital loss. So let's move on to direct investments. What are these? They're primarily listed equities picked in-house. They're fundamental, long-term positions with a quality overlay. We manage with a broad mandate, so we need to be very focused on how we do it with an intensity we feel is necessary. We run the sorts of screens you might expect, focused on growth, margins, and returns. But many of our best investments in the past have been in companies that are not yet filtering through on these sorts of screens, where there might be an element of change within the business, where we think the level, profitability, or quality of their growth might inflect. Often these ideas come from managers or fellow stock pickers in our network who we have known for years. And then we go deep into the company to understand its growth, profitability, business and management quality, and whether, crucially, we think there's an opportunity to buy them well. Always it's best to illustrate these sorts of things with an example. So let's take Westinghouse Air Brake Technologies Corp, or Wabtec for short. Wabtec's a leading provider of products and services to the rail industry, both freight and transit. When we first invested 3 years ago, Wabtec had been feeling a significant drag from the efficiency-driven cost-cutting programs of its end customers, but we felt the scope for that was diminishing. Indeed, we felt those same customers would soon need to step up their investment to drive the next leg of efficiency and also to decarbonise. Both of these would be driven by Wabtec's products and services. So that was the long-term view. Shorter term, we also felt that rail freight, which had been depressed through COVID, was likely to start to rebound, improving overall market health. That thesis has played out well, with Wabtec growing its revenues and earnings strongly, and the stock price responding. We continue to own the shares, including for Majedie shareholders, albeit having taken some profit. So let's move forward a slide and talk about our external managers. Here we own positions in a small number of specialist managers in areas that we consider offer persistent opportunity. Around half are equity focused and the other half are credit oriented, reflecting what we feel is a rich and complementary opportunity set in both parts of the market today. On the equity side, these are specialists with particular regions, sectors, or styles. For example, small and mid-cap biotech, activism, or Chinese equities. In credit, we've really broadened out our exposure in response to the evolving opportunity set, which I can talk through more in a moment. Across the board, what we look for are talented managers. These are often small teams operating as boutiques who are driven and aligned with our success. Many are capacity constrained and few have vehicles available to retail investors. We need to feel that their success has been and will continue to be a function of their skill. And to do that, we use both quantitative and qualitative tools, including appraising the drivers of their past returns and referencing them across our network. Once we're invested, we continue to monitor them to calibrate whether their edge and the area in which they invest remain compelling. So let's take our credit managers to give a little bit more insight here. It's a part of the portfolio that's perhaps a little less familiar to this audience, or at least the way that we do credit. At a high level, higher interest rates have significantly expanded the opportunity set relative to a few years ago. That's a good starting point, but we believe security selection is critical. You need to own the right names and avoid the wrong ones. We think strong fundamental credit analysis can enable compelling high single-digit to low double-digit returns from the performing part of the market, where companies are able to pay their coupons, but yields may become attractive because the market fears they may not. People like Mill Street in the US and ICOS in Europe look for situations where they believe these fears are ill-founded. Some of these companies, however, cannot pay. That represents a different sort of opportunity to take the companies with good assets but bad balance sheets through restructuring. This requires a very specialist skill set. Experts like Silverpoint, who we've known and invested with for decades, do it well. We like these sorts of situations because they deliver returns with a very different pattern to equity markets. And finally, let's turn to the third element of our approach, special investments. These are opportunities to invest alongside great investors in high conviction ideas. They're typically higher risk situations, given the higher return target, but their eclectic nature means they do all feel quite different from each other and from the wider portfolio. Each of these ideas must come from a trusted source, offer 20% a year return potential, and a way to realise value within 12 to 36 months. And when we're appraising these ideas, we really combine our direct investment and manager selection skills. We look for situations where we have both very high trust in and alignment with the sponsor manager, and where the specific investment thesis is compelling. I wanted, before I give an example, to have a quick word about disclosure. Some of these situations are quite sensitive. So, for example, where we might be backing an activist campaign that's not yet publicly disclosed. And that's why we use project names in our reporting. Our goal is always to be as transparent as we can be, subject to those sensitivities. So we typically disclose the underlying investment as soon as we're able to, typically in our quarterly updates and semi-annual reports. So let's take an example, one of the first that we did for Majedie shareholders since taking over the mandate. Project Bungalow, where the underlying investment is in the shares of the restaurant operator Shake Shack. This idea was brought to us by Engaged Capital, a small and mid-cap US activist manager based in Newport Beach in the US. We've known them for many years, and in addition to being invested in their fund, have co-invested with them multiple times across a number of sectors. They have invested and driven change in the US restaurant sector in the past, and we felt that they had a strong sense not only of what it meant to operate effectively, but also of who they could call on and work with to bring that excellence to Shake Shack. Prior to their investment in early 2023, Shake Shack was already a well-loved brand with a loyal following. However, as it grew from its roots across America and indeed the world, the format started to struggle to earn the margins and returns on capital that it really should have. Engage felt that an injection of new talent at board and management level, primarily from the quick service industry, would quickly enable tangible improvements to earnings. Things like standardizing rotas and new store builds, streamlining menus, and driving more effective marketing. They worked with the company to bring in consultants and refresh the board. Progress has been promising and the stock has responded well. And if you want a little bit more detail on either Wabtec or Shake Shack, you'll find a short video on each of them on the Majedie Investments website. So let's move on to performance. It's early days, but how have we done so far? The NAV total return, so including what we've paid out in dividends, since we took over management of the mandate on the 1st of February 2023, is up around 11%, which includes a drag from the legacy Lion Trust shares, which are now sold, and the effects of a phased transition to our management. Total returns, so the share price plus dividends, since the board proposed our appointment in early November 2022, is up over 40%. In other words, the discount to NAV has closed materially, reflecting that encouraging early NAV performance and a significant change in the shareholder base. The Barlow family still own around 50% of shares, but the remainder sit across a range of groups, across wealth managers, high net worth individuals, endowments, retail platforms, and, as you might hope, us, the people managing the money. We're delighted to have seen some long-term shareholders declare material positions in the trust. Now let's turn on to some of the terms and features of the trust for those who are less familiar. We've set these out on this slide, and I won't go through each element, but rather draw your attention to two particular points. One is the OCR at around 2.5%. This level reflects the fact that we take a very active approach to managing the capital, and that does bring an additional layer of fees. It's our job to reduce these where possible, for example, by including our in-house direct equities, where there is no additional layer of fees, and negotiating low or no management fee agreements for our special investments. But where we do pay fees, we always ensure that they offer good value to investors on a net of fees basis. With respect to our own management fee, this is currently 90 basis points on market cap, ensuring alignment with the shareholder experience. And that level steps down as the trust grows. You can see the detail of that in the footnotes. The second point I wanted to draw your attention to is currency management. Our goal is not to take a view on currency, so we hedge non-sterling assets back to sterling, with the exception of the special investments. The final point I'd note is regarding the valuation of our underlying investments. Everything in the trust is marked to market, typically monthly, but at least quarterly, based on underlying securities, over 95% of which have a traded price. And just to reiterate, we don't own private investments. So in summary, just flip one more slide. Thank you, James. We believe the market environment speaks to active management, and we intend to do what we have done throughout our history. The transition to our liquid endowment model is complete, and we're now focused on finding idiosyncratic opportunities, each capable of making 8% to over 20% returns. And we'll look to blend those in a way that creates true diversification to achieve what we hope will be a high single-digit to low double-digit per annum return over rolling 5-year periods. We think that should beat inflation wherever it lands. And today we see plenty of opportunity to do that. Though we would agree that markets are generally efficient, there are always pockets of opportunity for long-term weighing machine investors like us. And we see a real breadth of such situations today. That means we don't have to embrace a single asset class or a single style or a regional bias. We can build a compelling portfolio of bottom-up ideas, each with its own return drivers. I hope that gives you a sense of who we are and what we're doing at Majedie. And James, I'll pass back to you for Q&A.
Thank you very much, Olivia. That's really helpful. So let's have a look. So this is the strategy allocation here. So we've got just a big picture thing. So what determines the split of this between the different pockets?
Sure. So everything we do is very bottom up and fundamental. So we don't kind of start with a very strict strategic asset allocation across the different buckets. But in reality, we'd expect them to fall in ranges. So I mentioned that our goal with the special investments, for example, is to take that up to 20% in the near term, and that may go higher up towards 30 if the opportunity set presents itself there. So I would think about that in the kind of 15 to 20% range in the near term, but it will be driven by the pipeline that we see, and I can come on to that if that's helpful. The external managers will always form the core of the portfolio. So typically, I think that will typically be above 50% of the portfolio. The direct investments, I think, is roughly where you should expect it to be today. Most of that is stocks, but it also does include some of our slightly more thematic exposure around clean energy transition. So our copper exposure lives there. And then the balancing item is really the cash and the gilts. We will always have a little bit of that, but right now I think we are preserving some additional flexibility so that we can respond to the market environment. Hopefully that gives a little bit of a sense.
Yeah, because that was the question I was going to come on to. So what role do the gilts play? So as you say, it's a liquidity home, I suppose. But what do you think the outlook is for the gilt market at the moment?
So I would say we don't really have a particular outlook on the gilt market. I think the way that we've thought about gilts is that now that they do offer a reasonable yield, it presents us with a really nice tool in the portfolio. So ideally, we wouldn't be having too much cash at any point in time. And when I say cash, I include gilts in that. But the nice thing right now is that you don't need to be in a hurry to deploy. You can be responsive to the opportunities that come through. And because, we are very long term, we hope to manage this trust for many years. We've been building it up incrementally over time. And we've actually had some recycling a bit faster than we would have expected, particularly from some of those special investments, which is really why the cash is where it is. So I wouldn't say it's a kind of view on gilts per se. It's more that it's a sensible place to put your cash while you're waiting to redeploy it. And we have some other elements of the portfolio that feel somewhat similar to that. But you should expect to see us deploying that.
Okay, thank you. You mentioned copper just in passing there. What is the theory behind holding copper in there? Is it actually physical copper you're holding, or is it in the miners?
So it's in the miners, and we actually own an ETF there. We're not typically people who own ETFs, but I think in this particular case, it really suits our thesis very well. So our overall view on copper is that there's a very constructive long-term supply-demand imbalance, and that's really driven, and the most recent manager letter on the website provides a lot more color around this. But in a nutshell, it's really driven by incremental demand coming from the transition to a green economy, so electric vehicles and electrification of the grid, versus relatively constrained supply. We've got mine disruptions, decreasing ore grades, and some elements of environmental planning around that. So we feel very constructive on the long term. You might say, well, why don't you just own the copper through the commodity? And the reason that we don't do that at the core of our allocation in copper is really that we want duration on our side. We want to be, equities are great in that way. You can take a long-term view with equities. And with copper as a commodity, it's harder to do that. The copper price does get moved around quite a bit by short-term factors. And indeed, when we've been thinking about building our copper exposure, we are very cognizant that we need to be very aware of those short-term factors. So we put ourselves in the best position possible to take the long-term view. And we work with an external advisor to help us calibrate that, particularly around some of the push me, pull me from China. So that had obviously been a big drag on copper demand expectations, and it's becoming a slightly more constructive outlook there. So that's how we express our copper view. It's similar, incidentally, to how we express our uranium view. We've had a long-standing constructive stance on uranium, also through the lens of energy transition and supply-demand mismatch. And the core of that has historically also been in uranium equities rather than in sort of exposure to the spot price.
Okay, that's cool. What's been driving your returns recently? Because you're in the flexible investment sector, you are looking sort of towards the top of the pack at the moment.
Well, I'm pleased to hear that. I'm glad that people are generally constructive. So it has been a really pleasingly broad-based return sort of attribution when we break it down and we look at the various pieces. So maybe if I start with the directs portfolio, that has generally actually done a pretty good job. It's broadly kept up with the equity markets, despite looking very different to their narrow market leadership we've seen there. We have had some benefit early in our tenure as the manager from things like Adobe and Sage, so both software stocks. We've gone on to sell those because they've reached price targets, but they were a really nice contributor early doors. We've had some stock-specific successes in things like Wabtec that I mentioned, but generally quite a broad-based constructive view there. On the external managers, it's really been led by our equity-centric managers, not a huge surprise. The biggest single contributor is Helicon Investments, one of our largest manager relationships. They've really done an excellent job. The portfolio manager there, Federico Riggio, is a really exceptional, unusual talent, I would say. It's closed to new investors, so we're delighted to have capacity there. And then outside of equities, it's been a really solid return from the credit side of the book, which I think is actually quite really testament to their credit selection, because credit has been quite a varied area. But if I was to pull out a couple of managers there, I would say Mill Street, the US high yield focus manager I mentioned, has delivered very nicely, and Contrarian as well, which is our emerging market debt manager, which is a bit more focused on stressed and distressed situations, so does look quite different to the wider emerging market debt market. And then the copper and uranium, actually, I should say, they've had a good contribution so far.
Great. I mean, it's encouraging. I suppose the performance is coming from different parts of portfolios.
Yeah.
Which is, yeah, good. There's a question here about the amount of information that you put out on the portfolio. So we haven't got a list of sort of like your biggest holdings or anything here on the slide. Is that something that you actually do publish?
We do. So we publish everything that is over a 1% position in the portfolio semi-annually. So you can find that in our March 2024 report will be the most recent one. And then in our monthly fact sheets, we put out the largest 5 holdings in each of the 3 buckets. So hopefully that gives a really nice level of colour. And as I mentioned, we're particularly cognizant that people sometimes have questions around our special investments because of these project names. We do continue to refer to those by project name in the monthly reports for consistency, so people can tie them together. But if you ever want to know what one of those are, you can refer back to the most recent semi-annual report or quarterly investment manager letter, and you will generally find what those are, unless there's a reason we can't say it. But generally, we really do want people to understand what's in the portfolio.
Cool, thank you. Dividends. What's the sort of dividend strategy on here?
Sure. So this was very much set by the board. We manage with a total return mandate, and that's always been our approach. So some of our underlying holdings are cash generative, but most of them are total return, particularly the funds. And so when we were talking with the board about what would be an appropriate level of dividend to support from the portfolio and the way we want to run it, they felt, and we agreed, that about 3% a year on NAV was very, very sustainable. We could do that very comfortably. It was previously a higher level, as you probably know, but that was with a very different strategy underpinning it. Okay,
fair enough. Now, we've been backwards and forwards on cost disclosures and everything else for months now. But that OCR that you've got, the 2.5%, is that including the fees on some of the underlying managers as well?
It is. So that number includes our management fees, some of the vehicle costs, and the management fees that the underlying managers charge as well. It doesn't include performance fees, which I think is standard in the sector not to include those. And it doesn't include the cost of the debenture. We can talk about the debenture separately, but obviously that's a structural feature of the trust at the moment, which comes due next year and the board are discussing.
So if we just took at the sort of the fees at the high level fees, so your fee and then the sort of running expenses of the fund, do you have any idea what the fee would be then, the OCR fee?
So I think that is the 2.5. So our fees that are in there, and then the underlying fees to the managers, and then the vehicle costs. So so the only thing that we haven't included in there is the debenture.
Yeah. Okay. No, that's fair enough. I understand. Yeah. All right. Good. There are some very specific questions about some very specific holdings. So I suppose we could have a look at. So actually, let's pick out a couple of them. So just can you tell us a little bit about the Helicon Long Short Equity Fund, please?
Of course. I mean, I'm delighted you asked that one, James. It's our top performer since we took over the trust. So whoever asked that is being very kind to me. So they are a European-focused long-short manager. They have a really eclectic group of positions that actually span equities predominantly, but also some credit. The areas that they really focus on are Southern Europe, which has a very particular pattern. And also they do have some emerging market exposure at the moment. And the sorts of situations they'll get involved in are a little racier, I suppose I would say, but they do risk manage it really quite thoughtfully. So things like they've got some gold mining exposure. They've also got some utility and bank exposure in Southern Europe. they're very good at looking at situations that feel quite value-like and really picking apart the asset or balance sheet backing of those situations. Federico, who runs the fund, is extremely high energy, and has a really experienced team working with him. They worked together at their previous firm, Kairos, and span out a few years ago. So we feel really excited about them. I think we feel very fortunate we've been able to build the position we have. The fund is now closed to new investors, and we were able to invest prior to that with quite attractive terms as well. So yeah, a really great part of the equity-centric bit of the portfolio.
Cool. And then can you also talk about Paradigm Bio Capital, please?
Of course. So this is a long-short, small and mid-cap biotech manager based in New York. We started to feel much more constructive on the biotech, particularly small and mid-cap biotech space, around the middle of 2022. The sector had gone through a pretty painful drawdown, really reflecting the sucking out of liquidity from the wider markets, and to some extent, a string of quite disappointing clinical catalysts. And we wanted to find a manager that could help us kind of get invested in that space and really benefit from what we felt should be an element of recovery. But importantly, we really wanted an all-weather manager there. So a lot of our managers are actually long only, but here we think long short is particularly powerful, because the reality is that despite the returns to innovation over time, most drugs that enter the clinic fail. So you need someone who's got the ability to think really big about the potential of drugs, but also be grounded in the reality that most will fail. And we think in Paradigm, we've really found that. Again, it was a relatively new manager when we backed him, but he was coming with a lot of experience. Senai Asafor is his name, and he came from a really industry-leading long-short fund called Avoro before. And again, we invested quite early with them, and I think they've been very, very thoughtful about how they've built their exposure and evolved that as the opportunity set has evolved. So we felt very good about how they protected capital through the drawdown. Most of that was prior to Majedie under our watch, but then they benefited really well in the back half of 23. Back half of 22, did a decent job last year, and then have been, a little disappointing year to date, but nothing really to write home about there. I think they're doing a good job and really what we expect of them.
That's really helpful. Thank you very much, Olivia. We covered an awful lot of ground. I think you should probably rest about there, but thanks for the information this morning. We'll obviously be keeping an eye on what's going on, and we'll get you back on again in a year or so and see what the progress has been. But
super, looking forward to it. Thank you.
Cool. So thank you, everybody. We're back next week. We're talking to Menharden. And then the week after that is our next quarterly panel show. So we're talking about discounts. And for that, we've got Nick Greenwood on, and Peter Hewitt, and Ben Ritchie from Aberdeen. So it should be an interesting discussion. I think we're going to try and sort of look at what's been causing discounts and what can be done about them. And the week after that, we've got Nick Train on. So I'm going to say we've got a full list for months to come. So thanks very much for tuning in this week, and have a good weekend, and I'll see you next Friday.